Breaking news from Wall Street. Big tech is facing one of its most devastating weeks ever. In just 7 trading days, major tech companies have lost over $1.35 trillion in market value. Meta, Alphabet, Oracle, and leading semiconductor firms are all reeling. Investors are panicking over promises related to artificial intelligence spending. This isn't just a market correction, it's a complete reassessment of the true costs of the revolution. The numbers are staggering, and the impact reaches far beyond Silicon Valley. Tech giants plan to invest a staggering $660 billion in infrastructure by 2026. That's more than the combined GDP of the UAE, Singapore, and Israel. Investors, once thrilled by announcements, now question whether this massive spending will yield profits. Hyperscale companies are doubling their investments in data centers, chips, and computing power. But Wall Street is asking tough questions. When will the gold rush actually start producing gold? Recent earnings reports reveal some uncomfortable truths about pricing. As markets tumble, Goldman Sachs is quietly shaping the future of banking with. The investment giant has partnered with startup Anthropic for 6 months. Together, they're developing autonomous agents to revolutionize trade accounting and customer onboarding. These digital assistants promise to cut processing times in the bank's complex operations. Goldman's describes these agents as the next evolution in financial services automation. This isn't just about cost-cutting, it's about completely rethinking how Wall Street operates. Goldman plans to launch these agents soon, marking a significant turning point in fintech. The cryptocurrency market is facing severe turmoil. Bitcoin is dangerously close to the psychological support level of $60,000. Late Thursday, the leading digital currency dipped below $61,000 but rebounded to $66,327 by Friday morning. This extreme volatility reflects a major correction since Bitcoin peaked over $126,000 in October. Market analysts warn that the worst may not be over. Some predict Bitcoin could plummet to between $40,000 and $50,000. The current selling pressure mirrors the broader weakness in tech stocks, indicating Bitcoin's growing correlation with risk assets. For said liquidations are accelerating the decline as leveraged positions are automatically closed. Stellantis, the European automaker, just announced a shocking $26 billion restructuring cost. As a result, its stock price plummeted. The company is dramatically shifting its strategy, scaling back electric vehicle plans and reintroducing V8 engines in its U.S. models. Antonio Filosa defended the company amid growing concerns about the challenges facing large corporate splits. Stellantis is refocusing on customer preferences after a significant drop in market share in recent years. This move marks one of the largest asset write-downs in automotive history. Stellantis claims this reset will put customers back at the center of its global operations. As stock prices drop, tech companies are ramping up their investments in the marketing war. And Meta are paying social media influencers hundreds of thousands of dollars to promote their services. Some contracts reach as high as $500,000, but not every creator receives this payout. Generative platforms spent over $1 billion on digital advertising in 2025, marking a staggering 126% increase from the previous year. This influencer arms race signals the next battlefield for attracting users. Companies are now expanding their marketing efforts to major sporting events to drive mainstream adoption. Investment experts warn that emotional contagion is spreading across the tech sector. What began as concerns over spending has expanded into broader market uncertainties, affecting everything from semiconductors to electric vehicles. The correlation between Bitcoin and tech stocks highlights how interconnected today's markets are. Algorithmic trading is amplifying human emotions, causing volatility to spill over traditional boundaries. In Friday's pre-market trading, we saw some attempts at recovery, but mixed signals remain. The real question is not whether the market will stabilize, but when investor confidence will return to pre-crisis levels. As we wrap up this market analysis, several key factors will determine whether 2026 signals a temporary adjustment or the start of a longer decline. Companies must prove their massive investments can generate sustainable profits. Traditional industries, like automotive, face fundamental transformation challenges. Meanwhile, the financial services sector is racing to implement automation. The Bitcoin and cryptocurrency markets remain tied to widespread risk sentiment. In the coming weeks, we'll learn if the current market conditions represent a healthy recalibration or something more serious. One thing is clear: the intersection of traditional finance and global markets is more complex and critical than ever.